Welcome aboard Rocket Ship, the platform with the most relevant content for competitive examinations. This is Rocket Ship IS Lab and continuing with our series on answer writing for general studies papers of civil service main examination. We take up a question that you might come across in GS paper 3. Please read out the question carefully. Consolidation in banking sector would lead to enhanced competitiveness, operational efficiencies, and stronger balance sheets in general. In the light of this, critically analyze the scheme of merger of public sector banks in India. So as you can see, the question has two parts. In the first part, the question makes a particular statement, and in the second part, you have to talk about how they are arguments for both supporting this particular, you could say, a step, or for that matter, points of criticism that are directed against it. The real beauty of this question is that this question is actually quite easy, in the sense that the question itself talks about the potential benefits. It lists the three of the main benefits that merger of public sector banks is going to lead to. That is enhancing their competitiveness, leading to operational efficiencies, and creating stronger balance sheets. However, you are required to have some sense of these ideas. That is, you do have some idea what these things mean. Anyway, we are introducing our answer with going into the very historical background of the origin of public sector banks in India. That is, with the objectives of making banking facilities more inclusive and credit more institutionalized and accessible, and to prevent the concentration of economic power in a few hands. 20 privately held banks were nationalized in the two phases of 1969 and 1980. We expect that almost everyone here would be aware of this fact that during the tenure of Prime Minister Indira Gandhi, that a number of private banks were nationalized. That is, around 1969 and 80, almost 20 privately held banks were nationalized, and the rationale was they would lead to more inclusive and accessible credit facility, and to prevent the concentration of economic power in a few hands. During the socialist era, or even now, generally the ownership in banks is generally more distributed, because that creates far more, you could say, stabler banks and reduces the possibility of fraud. Anyway, the point is, with all these objectives in mind, a large number of banks, that is almost 20 banks, were nationalized during 1969 and 80. Bank nationalization indeed expanded the coverage of institutional credit and savings. Again, the point is, why is it always preferred that people can access institutional credit? You can understand very, very well that in the absence of institutional credit, that is, in the absence of bank credit, people would be forced to, for example, rely on money lenders, etc. And this can often lead to various forms of exploitation due to the high interest rates, that is the usurious interest rates that a money lender might charge from them. Anyway, the point is, however, with the opening of the economy after 1991 and the entry of new age private banks, the fragmented landscape of public sector banking was found to be inefficient and uncompetitive against the well funded and efficient private banks. The point is, generally the private sector is more efficient, more operationally efficient. Moreover, the private sector banks always even have greater access to, for an example, institutional credit. They do have access to institutional capital by reaching the capital market, institutional investors, and so on. Therefore, committees like PJ Nayak, this is PJ Nayak, Leeladhar, etc., had recommended earnestly consolidating the large number of public sector banks. That is, we have just talked about that there were almost 1920 public sector banks in a few stronger ones to serve a few objects, and this can be, as you can understand, can be achieved through merger of the large number of public sector banks to create new larger entities actually. So why merger of public sector banks is recommended? To serve various objectives, like to strengthen Indian banks to compete with their global peers. The point is, in the new era of globalization, the Indian public sector banks have to actually compete with the privately held banks, some of which are of foreign origin, and they can do it better if they had, you could say, optimal size, actually a large size, through which they can compete with other peers. To ensure fewer overlaps, for an example, more than few PSB branches in the same location. Again, try to understand it through the example of a village where they are, to say, more than one public sector bank branch, say 2 or 3 public sector bank branches. And what it would lead to, it would actually lead to fragmentation of their market, and in fact hyper competition also, that would be operationally efficient. Neither of them would be able to operate at an optimal level. Consolidation would lead to stronger balance sheets and to greater access to capital in the capital market, or for that matter institutional credit. It would be possible to have greater oversight, that is, you could say, greater supervision, including asset quality criteria like NPA ratio. Again, the point is, it would be a logistical nightmare to supervise a large number of public sector banks, say 20 public sector banks. It would be far more easier if there were fewer public sector banks. That would mean that the greater attention of these, you could say, the regulator, in this case RBI, for that matter some other body, would be they would be able to attend more. They would be able to pay more attention to the individual public sector banks, which would be fewer in number. It would also lead to building a specialization on leveraging relative strength. It is entirely possible, for an example, that a particular public sector bank has particular strength in a particular area. To give you just one example, try to understand it through an example, that Punjab National Bank has a housing finance arm. That means Punjab National Bank has acquired some specialization, some, you could say, institutional understanding of the housing market more than any other bank. So the newly merged entity, suppose a smaller bank was merged in Punjab National Bank, the newly created entity would have some greater specialization in housing finance market. This is the point we are arguing here, that is, mergers and consolidation would build a specialization, leveraging their individual strengths. Elaborating on these points, with the global ambition of Indian entrepreneurs and India's commitment to multilateral projects, for example, India's commitment under the, you could say, BIMSTEC and so on, the India-Myanmar trilateral highway and so on, all these projects require project financing, and bigger banks would be in a better position to compete with their global peers. To give you just one example, while in the passing, we can mention it in the passing, that JP Morgan is almost 5 to 6 times bigger than State Bank of India. So you can understand very, very well that even the smaller public sector banks stand no chance while competing with their global peers. While even our biggest bank is almost 1/5 or 1/6 of JP Morgan change. Overlaps reduce efficiencies. Mergers would lead to branch rationalization, that is, merging branches serving the same area, as we were trying to understand through the example of a particular village which had more than one particular, you could say, which has more than one public sector bank branches, with requirements under norms like Basel Accords to have comfortable risk capital position. Consolidated PSBs would elicit greater interest from capital markets institutional investors, etc. Again, it's always recommended that banks do have access to, you could say, comfortable position in risk capital, that they do have sufficient risk capital to, you could say, actually deal with the business cycles. Sometimes what happens, due to the cyclicity of economy, there is chance that the bad loan portfolio of a bank would rise. In that case, the bank would be better served it had sufficient risk capital. And to raise this risk capital, a bank has to either reach the capital market or the institutional investors. And generally the capital market and institutional investors, they are more willing to fund the stronger and the larger banks. Too many small banks escape oversight, as the point is it would be a virtual logistical nightmare to have supervision over a large number of banks. This means asset quality criteria like NPA ratio may not get requisite attention. This creates conditions fit for frauds, that is fragmented landscape of public sector banks, that is a large number of public sector banks. It creates conditions fit for frauds. Consolidation of banks makes it easier to enforce, that is it makes it easier to supervise over the smaller number of banks. Moreover, consolidation can help banks specialize, building on their relative strength in particular areas, as we had just talked about the example of Punjab National Bank, which has a housing finance arm. However, there are points on which bank consolidation has been criticized. That is, it's not as if it's all hunky-dory with bank consolidation. There are points on which they have been criticized. What are the criticisms directed at bank consolidation? It's said that stronger banks may become saddled with bad loans and weighed down by weaker banks. Again, this point is very intuitive actually, that the smaller banks which do not have as, you could say, good asset quality, or for that matter which are weaker in some other ways, may actually weigh down the stronger bank. Again, this is a very very pertinent point. Rationalization, that is reduction in branches, might lead to a setback for financial inclusion. Again, we can mention this in passing, that the public sector banks actually serve dual objectives, that they have to be profitable at the same time as serving, you could say, public needs. So if we reduce the number of branches, some people actually raise this apprehension that this would lead to a setback for financial inclusion. Operational issues like software integration, human resources. We are not going into the detail of human resources because this point has often been raised by the unions, bank unions, and they might have some cultural differences. Some of the banks, you could say, could have better work culture. For example, Punjab National Bank or Bank of Baroda, which are generally much more aggressive. They are to the same level, almost same. They are aggressive to the almost same level as their private peers. That's not the case in some smaller public sector banks, which may not have, as you could say, as geared up work culture. So these problems, actually these issues, are generally raised by many people who criticize bank mergers. But it should be added that with emphasis on digital payments, the offline branches are not the only determinant of financial inclusion, that people can actually do most of the transactions through their mobiles, sitting at their, you could say, homes. Also with potential gains like rationalized operations, stronger balance sheets, all these things we have discussed, and effective supervision, because a smaller number of banks are more, you could say, more actually they are, it's possible to supervise them more, you could say, with more attention actually. Issues like weaker banks becoming a drag on the banking system can be better taken care of. So with all these potential gains, that is the gains in operational efficiencies, in leading to stronger balance sheets, that is generally the asset quality would be far better, and moreover they would be far more easier to supervise. All these gains actually outweigh any potential, you could say, setback that might be a result of banking consolidation. That's the point we are trying to make here. with this, we call it a day. We would reassemble for the next lecture in a few days. As usual, we wish you all the best. Thank you.